Let's get more on that. Melissa Lee is at the CNBC and Institutional Investor Delivering Alpha Conference in New York with a very special guest. Melissa.
All right, Brian, thanks so much. Afsaneh Beschloss joins us now. Afsaneh, I wanted to talk to you about ESG and the rise of ESG because $12 trillion is a lot of money. So what has really driven it? Has it been, for instance, the interest of millennial investors?
Very nice to be here with you, Melissa. ESG, the numbers that we're seeing, the many trillions of dollars that we're seeing, I would just be careful with those numbers a little bit just because nobody really has a very good sense of the total size of the market. It certainly is increasing, no question about it. And the millennials, no question, have much more interest in the environmental and the social and the governance aspects of how a company is run than previous generations. But they are still not the biggest investors. So I think the interest is obviously generated by the millennials, but is also by large institutional investors and really investors at large.
In general, ESG is viewed as investments in public companies, impact investing, investments in private companies. You do both.
Absolutely.
So which sorts of sectors are the hottest sectors for you these days?
The most interesting sectors as we speak are education. There's so much going on. We know the problems in terms of both access and outcomes when it comes to education across different populations, whether we're looking at the US or we're looking at Europe or in emerging markets. And EdTech is providing tools for, let's say, kids with different learning abilities to get up to speed at their own speed. It allows, so it sort of provides access to more people in a more equitable way. So I think that's a very interesting area, and it's growing very, very fast, again, not just in the US, but also in particularly in Asia as we speak. The other area that is very interesting is the applications of technology to the health sector, again, improving access and outcome. Clean energy, renewable energy, obviously a huge, huge area when we talk about the 12 trillion. Certainly, efforts to use cleaner energy is one of the biggest areas we're focused on. And then last but not least is affordable housing, where you can provide housing for low-income populations. And obviously, San Francisco and California, we've been talking about a lot the last few days.
Right.
But at the same time, as you provide community services, health services, and make sure that with the services you're providing, you have a healthier population that can actually pay the rent, so it's better for business.
So if we can just sort of drill down on clean energy, because that is one area that our viewers can invest in because there are public opportunities there. Is that an area of the market that does well in good times and in bad times? Because it's viewed as sort of a riskier area. And so when we see a risk-off movement in the market, you usually see a lot of the clean energy companies sell off.
So I think we have to look, and it's company by company, obviously. We have to look at each situation. But the most important thing with regard to energy right now is the problem with stranded assets. So if you are an investor in what is being called stranded assets, which is things like coal or heavy oils, or anything that is hugely polluting so that you have to spend a lot of money on cleaning up after yourself, obviously that cannot be a good long-term investment. And I think more and more investors see that, whether markets are going up or they're going down. Similarly, anything that increases energy efficiency, if you're in a downturn, you do want to cut costs. So anything that improves energy efficiency is by definition good. So that's why things like LED bulbs or other ways to reduce your load in a given city has been so popular under all economic circumstances.
How should people think about individual investments? And I know this is not one of your positions, but Uber, for instance, on the surface, it seems like it could fit into an ESG portfolio. Does it?
Really great question, because it has a lot of advantages. So let's say for let's say women who have a limited number of hours to work in a given day, great. You can become an Uber driver. It does not, there's really no barrier to entry in that way. So that would be a big positive. The negative is that Uber collects a huge part of your rent. And then says that you're not their employee, so no benefits provided to those workers. It's very different than, let's say, a credit card company that provides an app, if you call it that, and charges you 1%, 2%, 3%, 4%. You know, this is in excess of a third.
So
of the
socially,
income.
it doesn't work.
It doesn't work.